Joe's Bar and Grill.
Hey, where's my burger? So I'm sitting here with Christion.
Good morning.
We just wanted to talk to you for a sec. You got a second?
Okay. Yeah.
Well, the reason we're wanting to get you on the line, we're wanting to create some content around raising capital and dealing with investors, best practices for those types of conversations. We are going to record this, but more importantly, we wanted to talk to you about maybe doing a webinar together, just recording a Zoom where we go into detail of this. We want to create something for our clients because we're just trying to figure out what is it that makes a difference between these guys who we deliver them 200 leads and they raise $5.8 million and the others, they get 100 leads and they don't raise squat. So we're talking about you and your days and all the capital you raised there. We'd love for you to just chime in on some of the things that you think made that successful. Either one of you guys have told me the story before, but I'd love to hear it again of where the first time Kent came and got involved and he went and sat down in a little makeshift cubicle and, raised all the money in like, I don't know, what is it, an hour and a half, 2 hours, something like that.
Seemed like it was before lunch.
Rivermont deal that we closed in January of 2003. I was hired December 2nd and they closed it in early January. And it was a pretty good sized deal.
But it seemed like to me you came that first day and had the money raised before lunch.
It was pretty fast, but I think what that does is demonstrate the real answer to this. It's not so much the content, it's the relationship.
It's true.
Had a great relationship with a lot of these people, and that made it a lot easier for me.
So yeah, help us understand that. What were these leads that you were talking to? What was the size of the raise? How fast did it go? And what are some of the key points that you think made a difference there?
It was probably about a $6 or $7 million raise, but it was a very attractive deal, had great returns. This was when cap rates were high and falling, which made it a great time to invest. So you had a lot of people lining up to do so. I remember when we took over, many of the B and C class properties were actually in the double digits on cap rates. And cap rates fell down to 5 and 6% within a few years. You can imagine what that did to the returns. So there's a lot of people wanting to invest at that time. So that made it pretty easy. Besides relationship, one of the things that I do, especially since I was new, I like to build trust with investors, so I don't hide anything. I give them all the bad with the good, and I think that's one of the problems that many people are afraid of doing. They're afraid of showing any of the weaknesses of the deal. And while you may not want to put that in the content that goes in the package, it has to be part of the personal conversations you have with investors.
Yeah, what does that look like? How do you start off by talking about that? Is that something that you have planned into the call, or does it come up as they bring up concerns?
Yeah, like for example, there was a deal that did that I did not like, but I was told to sell it and I did it. I was concerned about the neighborhood. Mike knows which deal I'm talking about.
Yep.
So I brought that up and the deal sold and the returns were just okay in the pro forma, but it way underperformed that. The fact that I told the investors beforehand my concerns also helps mitigate some of the responsibility for the fact that they weren't formed. I told them. And so that helps preserve the relationship somewhat. One of the things I do with any discussion that I have with investors is I usually tell them, when I'm giving them the overview on the property, I always ask them, do you want to hear my pros and cons with it? And then I tell them straight out, here's where the benefits are and here's where the concerns are. And so it gives them a pretty fair analysis of the deal so they can see how, when we underwrote it, that we did our job.
Well, and it gives you credibility.
Yeah.
You're not just talking about the high points of the property, you're talking about what you perceive as potential downside risk.
Yep.
What would you say the average demographic was in the people that you were dealing with? What type of money were they bringing to the table, and why were they investing in the first place?
On average, early on in those years, the average was probably around $250,000. It became less and less as when they introduced the investor dashboard with IMS and some of that back in around 2015 or so. When they started introducing that stuff, it made things a lot easier to manage, and so we started reducing the minimums on that. And then so after that, the average became about 150 or so, maybe 200.
And if you could talk about some of the demographics of these people, are these, multi-millionaires that are just putting some extra cash away, or?
Many of them came out of California, which pretty well tells you what they need to fail real estate in California. They were millionaires.
Yeah, back then we could qualify them on their house.
Oh, yeah.
Yeah, so it's like, God, if you own a mobile home, that you own the real estate it's on. You qualify. Everybody was qualified then.
Yeah, many of them had multifamily properties that they had in their rentals or whatever. That's where we found them, title searches that we had. That's how we invited them to the different workshops that we had in California and other markets, disposition markets. But they were used to not getting positive cash flow on their properties there because of how expensive taxes were and other things there. So they had negative cash flow, almost every one of them. When we came to the table and said, look, we can get you a deal that gives you consistent cash flow every month. That was kind of a new thing for a lot of those people that made it very interesting. That we also talked about the strategies that had in terms of market selection that made a huge difference, and how taking that right down to the neighborhood level where we get the right property in the right locations and all that. That's based on the gap analysis that did.
Yeah, it wasn't unusual to take a guy out of a duplex in the Bay Area that he had $1 million equity in, but was losing $2,000 a month on. And move him into 20 or 30 units into like Oklahoma City or one of the places we were going to at the time, and having him buy 30 units with that same equity and getting $4,000 or $5,000 a month of positive cash flow. I mean, it was not a hard sell. And then when Kent started doing it, it was like, and if you don't want to manage the property manager and worry about that, here, you just invest with us on this larger, Class B property or B plus.
Another thing that made it easy for those types of investors back then is because many of them were doing 1031 months because they were coming out of the properties they had in California. They sold them and then rolled their money into one of our deals. We were able to accommodate 1031s very easily because of the tenant common rules that they had back then. You could have 20, 25 people as TIC entities in a deal, and that stopped when the downturn happened in 2008, 2009.
It just became not fashionable anymore.
But we acquired a ton of clients with a lot of money during that time period. The next wave of clients that came in after that downturn was in about 2012 when Obama passed the Jobs Act, and which created crowdfunding for real estate. And one of the first firms that started that, I found, we were their first client out there, and we raised tons and tons of equity through them because of that.
506C, baby.
Well, let's talk about that because that's most relevant to who we're dealing with now. When you turned that on and you started dealing with these brand new relationships in 506C, what was the process like then?
What helped a great deal with that one is they were the first player on the market. We were the first investor, or the first sponsor on their deal. So there wasn't as much competition as there is now. There's a ton more competition now to deal with when it comes to this kind of thing, and trying to get your plaque in front of them is not as easy. They made it pretty easy. The thing I liked about them is that once we paid them the fee and they brought us some clients, those clients became our customers. After that, we could solicit them after the fact once they invested in our deals. And I liked that a lot. They controlled the relationship prior to that, so anybody that didn't come into our deals, of course, we wouldn't get those leads, but we were able to keep leads that did invest. And that allowed us to grow the business because many of those investors invested 5, 6, or 7 times.
So somebody comes onto the platform, they find it, they ultimately say they want to commit, and then did they talk to you before they invest that money, or did they invest strictly through that platform?
Many times they had a question about the deal, so they would post it on the site, and it would get sent to me, and then I would respond to those questions. And many times those turned into phone calls, and then they would go back and make a commitment on the website and go through the investment process electronically.
Yeah, but Kent, you ended up talking to most of those guys, didn't you? If not all of them?
Most of them, yeah, probably about 90% of them.
And so what were the main ways that you dealt with those, what started with a question about the deal and turned it into a capital raised?
The same tactics. I said, well, can I give you a high overview of the deal, what I see as far as the pros and cons, and then I would lay it out. I would say, okay, here's your strategic opportunities. This is the reason why we selected this property. Here's the things we like about it. And I had several key points that were really demonstrable. And I would also refer to where those points were at in the package, because at that point they usually had it in front of them, and I would take them to those to show them that information in the executive summary I provided for them. And then I would give them the negative points as well. And that instantly built trust with these people. And they could see the picture of what we were looking at. And they could look at all sides of everything. It really helped them to, I would get quick commitments out of that based on that, because they felt like they got a very accurate picture of what it is. They weren't feeling like they were short anything, and it made all the difference. I was also thinking in terms of content in the package, though, there's still some stuff that I see a number of sponsors do that doesn't work very well. You know, a number of property packages they put together that have a real elegant look to it, but there's often not much substance to it. There's not a lot of detail, and when there's not a lot of detail, there's usually a lot of questions investors have about there's trust issues. And so, just kind of like what I said when it comes to revealing the good and the bad, I like to reveal everything, and so I provide disclosures on everything on the deal and all the detail, but I summarize all of that up front so that those that want to quickly get through the thing and see whether or not they're interested have all the teasers and everything up front, and then the detail follows after that. And I refer to the detail in my summaries at the beginning, to look at such and such page, so it makes it easy for them to get around and see what they need to see.
Yeah, your packages are fabulous, Kent. A lot of information, but everything's covered pretty well in the executive summary.
Yeah, the key to it is you've got to have the key selling points have got to be up front. If they have to go find them in the deal, it doesn't work. And that would be true whether they provide a simplistic package like many of them are, or the more detailed one. You've got to have the key points up front.
I was looking, the other thing I noticed that you did, Kent, as long as I've worked with you, I never realized you did this, but the email that you sent out on deal, and had all of those salient points and a reference, I think there's even a hyperlink to the pitch deck page. Anyway, it was, here's the salient points to the transaction. This is where you can go and look up and read more. And I thought that was just so well done.
Yeah, you got to give them teasers in the email too, otherwise they're not going to open up the package.
Yeah, didn't give all the information, just enough to tweak their imagination to open the package.
You have to make it enticing to move along the path, and you have to lay out the path for them.
So what are some of the ways that you initially start a conversation and build rapport with somebody that they're even going to listen to you on all your points?
I usually ask up front if they've got some particular questions, because then that can lead into a great discussion right there. I love it when they come with questions of the deal, but if they don't, then I'll ask them, a little bit first about them, if they've invested in real estate syndications. I want to know a little bit about how much they know about this kind of stuff, so I know how to approach it with them. I'll ask some information about them and their experience, and then something about what they're looking for based on what they give me from their experience. I try to segue off of that if I can, and then I can take it from there. If they haven't had any questions, then I'll ask them if I can give them a high overview on the project, and that's when I give them the pros and cons. And then from there, if I've done a good job and they're a potential investor, the deal should just sell itself.
The other thing I noticed that you do is have a tendency to get to know a little bit about them on a personal level before you even start in on that. I've heard you do that a number of times.
Yeah, you want to know a little bit about their experience, what they've done, and what they're looking for.
Why are they investing, and why are they looking at this deal?
Yeah, the approach is quite different after that. Once you know that information, it makes it a lot easier to figure out where you need to go after that. But if you start to sell a deal and all the details and everything like that, and you're talking to a guy that doesn't know much about it, investing in these kinds of things, then you're starting in the wrong place.
So in a world with so much information and distraction, you have any advice on how people can actually get those people to pick up the phone in the first place?
Have a good deal.
It's the teasers that you give them. You've got to have, you got to know the deal really well. You have to go through the due diligence just because, if you didn't put the deal together, you've got to, somebody else did it and they brought it to you like what did. You've got to dig in through it. You've got to know the deal incredibly well first, so you can put together then the highlights that you want people to pay attention to, which are the teasers that bring them back, into looking at the deal. So I go through all the due diligence on the deal as much as I possibly can get.
Speaking of that deal, Kent, because that's going to be a failed raise. Tell us, why do you think that raise failed? I know you're starting to get some traction, but you came to it too late. You only had a week to work with it. But
I think the biggest problem that the investor base that I sent it to is that these people were used to looking at institutional grade or pretty close to institutional grade multifamily properties, and that one was not even close.
Okay, so that was to the investors that you and I have worked with because that's what we did. But there was a period of time when we were not doing investment grade real estate, and we still got those raises done, except for maybe one or two cases. Like, for example, our old company, they had one in Atlanta that failed, and it was in the right part of Atlanta. Why do you think deals fail, raise the money? Because the reason I ask, Ken, is that we typically send 250 investors that are accredited, have the capacity to do it, probably have had, most all of them have had a lot of experience, and they responded to advertising saying that they're interested in that deal.
I'll tell you, this has to do, I think, with the education of most investors. When you look at that deal that gave, besides the fact that it didn't have the type of property that fit the investor base that it was sent to, whether or not it was that investor base or another investor base, they wouldn't have known that market at all. It is a tertiary market. It wasn't recognizable to them. And so they don't have a lot of information in their minds about, that could be a good opportunity for me to look at. So it's got to be a good market.
But it's a great market. It's just like you said, it's a tertiary market.
And then the type of property, it has good appeal right up front, is usually a newer property, or one that's been significantly rehabbed, that's in pretty good shape. If you look at, older properties, that it's harder to get those to go for many of the bigger investors, or at least many of the investors I've dealt with.
So part of that was built, half of that was built in 2023.
But the other half was built in the 50s.
And that was in the process of being rehabbed.
Yes. Well, they had rehabbed quite a bit of it, but they were going to do some upgrades. But it still didn't have the look and feel, say, of a larger multifamily property. When people talk amongst themselves, with other investors, they compare notes how everybody's doing. Oh yeah, I've invested in this deal. Many of them recognize the larger multifamily properties were doing incredibly well, and that was pretty common. I mean, before I started there, they did two or three properties. They did three properties that were Class C properties, and they were smaller raises. They were able to get the money raised on those, but they didn't do as well. And by 2004, after we'd done several institutional grade multifamily properties, we discovered how we can get really good returns off of those. They were doing incredibly well. The cash flow was incredible. The investors were just loving it, and it was so much easier. As a sponsor, that's when we decided we weren't going to do any of those Class C properties anymore.
Okay, so I'm a new guy. I'm starting out, and I need to put up, say, $250,000 on the down payment or the earnest money deposit for the PSA, and I don't have that kind of money. I mean, how do they get that money? Can they go to a newer sponsor might have the capacity to run it? You and I both know those Class A properties or B plus properties that we're buying, they're easier to run because you can get really great management, and because they're newer constructed, there's not a lot of maintenance to them, so they're easier to run. But how do I get involved in that? I mean, can I still go out under a Reg C, 506C, and do a pre-subscription round with friends and family to raise that earnest money? Can I still do that?
Do you have people doing that kind of stuff then, Mike, that are potentially investing through PREIshare?
Yeah, but I don't think a lot of guys know that you can do, our securities attorney used to always tell us you can do a pre-subscription round to raise the earnest money. You just can't put it at risk without the subscription agreement.
When you say put it at risk, what's considered at risk? Is that going past deadlines, or is that?
There's a period of time when the earnest money will probably go hard, when it's not refundable. But until then, it's refundable based on a number of contingencies. And one of those can be financing.
I would suggest the best thing, though, since you're going to need a subscription agreement anyway, you may as well just get it done up front.
Well, the reason you don't want to necessarily do that, Kent, is that, and we did that a couple times, and we would go out and just raise due diligence money, and we'd pay the due diligence money, but we would raise the earnest money deposit, and that was on a pre-subscription. It was fine as long as you followed it up. If you're going to go ahead and raise more money after it was no longer friends and family, then you had to go and do the full subscription agreement. At least it allowed us to test the waters, to see if there was going to be interest in the property, if it was going to get past due diligence, so that you didn't have to spend another $40,000, $50,000 on the legal fees to get the filings done.
I designed a little one-page executive summary for that. It had the disclosures at the bottom, and it had the salient points on it. Had really a pretty good picture of what the property was, and to say, let us know if you might be interested in something like this before we pursue it. Right now, we've got it.
Yeah, you had it under an LOI, yeah.
Yeah.
So would you give those guys a preferred return for coming in early on that, or do you just say, hey, your money's not at risk, you're just going to put it into an escrow account?
Right.
Well, they knew, a lot of the investors that we had there, they also knew that these deals went pretty quick.
That's why we didn't have to give them anything, because they were in. It's like, I want to be first called.
Yeah, many times I could raise nearly all the equity within a couple of weeks.
And that'd be about the time we'd be under contract. We're pretty efficient. We'd send 3 or 4 guys to do due diligence and walk every unit, but it was done in 2-3 weeks. I know, we used to get those reports back, and it was like, and that started the eviction list. The guy in Oklahoma City that had a Harley Davidson in his front room that he was rebuilding in his front room.
So how much of that do you share with investors that are getting in early? Do you share all the details of every bit of due diligence that's going through?
Yeah, I do. I talk about, in that situation there, the one I walked as well, we had a list of things that we, like Mike said, we'd tell them we'd walk every one of the units, put a list of items that needed to be repaired, or at least if they weren't going to repair it beforehand, that they needed to give us so much money at closing to get it done.
Because then you had to know exactly how much money you had to come up with to remediate the property.
Which I could definitely see when you guys already had the success, but going back to what you were saying, Mike, somebody that's newer into the business, how do they pitch somebody on that? How do you even let somebody know that you are advanced enough to protect their earnest money if they put it in with you?
Well, for example, everybody I talked to has got a friends and family list. Had $300,000 before he went in on that property. He could have used that money. He probably did use that money for his deposit. I thought had a fabulous deck. And when you got through with it, it was sort of like, oh God, I can't believe you didn't think about that, or you didn't think about, you picked that thing apart in a nanosecond, but you've been doing it for 30 years.
Yeah, there was things that were missing that needed to be done on that. But that's what happens quite often when you make these really elegant packages that are very simple in layout. They're usually missing a lot of details.
Well, and I know if you're doing a one-on-one pitch, sometimes you do want to just get through the information enough that they can decide, do I want to look further into it? But probably provide links on a lot of that stuff, right? Like, hey, if you want to...
Well, that's what Kent did. He sent an email, which I've never seen before. I didn't know that Kent did this, but it was an email, and it just said, it would give a bullet point that was not fully developed. It was like you see in the news when they give you a teaser right before the commercial. Prominent government official, nearly a victim of an assassination. Then you got to see what the hell's that all about, or, really great news for all of you who drive cars, and, and it's like, what's that all about? I have a car.
Yeah, right.
And so, you have to, that gets them into the deck. Kent had about 20 bullet points he had in his email with the deck.
Part of the reason why I did that is because he didn't really have a good summary up front.
Well, I thought it was brilliant.
Yeah, I usually don't do that much. I usually just 2 or 3 points, maybe 3 or 4 or 5 points in the cover email, just enough to tease them to open up the deal. But there was a lot of things missing in his summary up at the front. He didn't really have much there.
Well, still, even at that, it was intriguing enough to me that I was familiar with that deck, and I went through it, each one of your points, because to me it was intriguing enough that I went back and looked, because I was following some of the points you were making, some of the things I was not really aware of, and I was pretty familiar with that deck. But a lot of guys I see, they just send out, please see attached deck, and that's it. That's all you get in the cover.
That cover email, Mike, it's important to get them to go to the next step, but the first step actually is not in the body of that email. It's actually in the subject line, because when it gets into their inbox, many times they'll delete it just based on what they see in the subject line or don't see.
So what was your subject line?
I usually mention something about the basic strategic opportunity is on the deal.
Can you give me an example?
Value add, below market, things like that.
Top markets, United States.
Yeah.
Value add.
Yeah.
Yeah, that would get me to open the email. When I saw your cover email, it was substantially better than any of the ones I've been seeing for the last 3 years.
Can you forward me one of those?
We were talking about a deal that didn't get the raise done, but Ken only had a week with it and had enough soft commitments that we almost could have closed it. Only one firm commitment, but he only had a week with that. And let's face it, that was, even though is a fabulous market, no one's ever heard of it. You could almost hear them open their phones and ask Google about, like, where is it?
It's harder to sell. Many people wouldn't know it unless you're from that area.
I've worked with Kent long enough. He's raised hundreds of millions of dollars for us. I almost think, listen, give me 10% of the GP interest. I'll come on as a co-GP with you and help you with that process.
If you just need somebody that can go through your offering materials to offer suggestions on it.
Not a lot of people are going to admit that they need somebody to give them a consultation and talk to them about what to improve.
It's a standby option. Kent wasn't sort of semi-retired. He probably never would do that. But I imagine there's a few guys that would, because Kent loves doing that. But a flat fee to review the pitch deck.
Well, to comply with the Reg D offering stuff, I would need to be part of the GP.
You can review their deck for a flat fee.
But to sell it, I'd need to be part of their GP.
I guarantee you, a lot of these guys that are kind of new to the business, they don't have a Kent. Let's face it, when we got you had a pretty impressive track record because you were with all those years, doing the customer management for $5 billion of assets.
More than that. I had 7 clients and each was over $1 billion.
Okay, so I was off a couple $1 billion.
Yeah, there was an awful lot of money, but I also had a great team. That helped a great deal. I was the leader on the team, but I was blessed to be given an amazing team when I started out.
Well, same thing happened when you came to. We had an incredible team, but we didn't have anybody that had your skills, understood the investor's mind, and helped them make the right decision, even if it wasn't to invest.
I mean, they were using, what was that, something star, one of the clients had put together.
Yeah, that was actually written for us by one of our clients.
I looked at the material that they had used to put together the first 3 deals, which were pretty small raises. And I could tell that it was all based on relationship because they couldn't have sold it based on what was in those packages. It was basically providing financial statements. That's all it was.
Of course, then we had the advantage, even though you don't have today's technology, identify accredited investors that we have today. Back then, we had to have prior relationship, and we'd met with those guys months ahead of ever pitching them a deal.
Yeah, we knew those investors already. We knew them very well because I met all of them. Most of the investors, early on investors anyway. I met them in person.
Yeah, and spent a week with them in the market that they were going to invest in.
Yeah, and I would upset the brokers there too because I ended up with a lot of them investing with me instead of doing what they came there to do that the broker hoped that they would do.
Yeah, we'd have 15 investors on those typically, on average. Kent would take about 80% of the capital that was available for investment, that the brokers were showing them that they can buy their own deal and manage it through a local manager. The
thing is, I had really good materials there, put it together, but the deals just sold themselves, Mike. They always did. That has always been my thing. If you put it together right, it had the deal. You don't have to put any sales pitch in it. In fact, I don't like doing a sales pitch. The deal should just sell itself.
So that's another thing that maybe, because as you know, I've been kind of investing in these as I've gone along, and most part they've been pretty good because I got a pretty good eye. But I was invested deal, and I might go back, rearrange my portfolio a little bit, and buy that deal myself. Maybe what some of these guys should do is before they decide to pull the trigger on a deal, have you review it, and have you review it for a fee, and just say how marketable is it.
And that right there would actually then take it to the next step. That would give me the introduction to them, and then if they like what they see with my recommendations and stuff like that, and say, well, let's just go ahead and have you sell it then.
So you could say, I'll give you an initial review of it based on the market conditions and the asset itself. Say, I think this is marketable and under certain circumstances and who it needs to be pitched to. I think that would be very, very useful.
Yeah, this is something that they never have done in crowdfunding. They never had a sponsor coach. You want to be able to take them to the next level, and you won't get that opportunity unless you get in front of them. My recommendations are not their recommendations to the investors.
How willing would you be to share the analytical tools that you've developed over the last 30 years?
I think that would be a good idea. I'd probably want to clean it up a little bit because it was designed for me. I'd have to make it so that it was something that would be more friendly to most people, and mine has a lot of bells and whistles in it.
There's been fierce debates, as you well know, about who owns those analytical tools. And at one time, I remember there was discussion amongst our group to sell those analytical tools because they were the best. I saw many software programs that claimed to be the be-all, do-all. Problem is, you kind of developed them for multifamily, and you might have to develop them for other asset classes.
Because it's different animal. The kind of elements you would want to put in for a storage property would be quite different from what you would want to put into a multifamily.
Those have been carefully guarded for years and years and years. I mean, there's guys that wrote very extensive analytical tools, not nearly as good.
one of the things I wanted for people that were analyzing and underwriting the deals initially, it used to be that you would look at 2 or 3 properties and you would find one that worked right away. But because the competition became bigger and bigger as time went on, I mean, when we started, there wasn't that many players, in 2002. By 2015 or so, there was just too many players in the market. And so you'd end up having to look at, 20 or 30 deals before you found one that you would want to do. And so I had to make the model more efficient. And so what I did is Red IQ at that point came out in business, and then they had a way to take, this is before AI, but they had a way to take pretty much anybody's rent roll, read it, and convert it into data that had a standardized layout. I could then, within a few minutes, input that into the Red IQ thing, have it come back with the worksheet, and I copy and paste the rent roll with that standardized layout into my model. And within minutes, you've got almost all your analysis done based on what you saw in the rent roll and their financials, monthly financials. So our underwriters could canvas a whole bunch of deals real quickly within a day.
You used to also do a spreadsheet that had sensitivity analysis, which is a form of Monte Carlo simulation. And a lot of guys just do not do that. And the problem is then when you go to sell, do you just put the numbers in that came as a result of your calculations, which are just your best guess? Kent's had sensitivity analysis and say, here's the top performing possibilities of that market, and here's the lowest performing out of the comps that he would pull, and then run sensitivity analysis and give the most probable outcome. Sort of gave you a chance to say, here's worst case scenario, here's best case scenario. Here's what we think is likely to happen with that property.
It was also CYA too, because if I give them a chart that shows the range of returns on varying inputs like cap rates, exit cap rates, then it really, if it doesn't perform exactly, then we say, well, we did give you the possibility that if cap rates change, that, this is what's going to happen.
I think that's so crucial, because anytime I see something from somebody trying to pitch me on a deal, even if they're not doing a pitch, I always assume this is your best case scenario. I should probably dumb this down a little bit before I even consider.
And Ken, we'll put that range in there for you.
We did actually. We usually, if you've done your homework right and you've really found a pretty good opportunity, then you can afford to dumb down the returns, because it's better to underpromise and overperform, although I hate to use that saying because of somebody that used too much and that never really meant that.
Yeah, well, and that, unfortunately, I also see that as there's some people that have been taught that, and then they just show these mediocre returns when they really believe it's going to be better returns, and now it's a harder sell for them to get the deal pitched.
If that's happening, and it happened a lot back in about 2007 when things started to get too heated in the market, and you found a lot of people doing financial engineering into their deals to get them to work. Like one thing that, remember this, Mike, when he would pay a little bit extra money and to have $300,000 or $400,000 given to us to support cash flow for the first few years on the deal when it wasn't cash flowing right.
And that was financial engineering.
Yeah, and so you could all of a sudden promise the cash flow, but it was artificial because you were paying too much for the property.
We just had somebody ask about this.
Just when you get a lot of that financial engineering going on in order to get a deal work, like variable interest rates and stuff like that they put in these deals, that's when the market is paying too much for properties, and you're going to see a downturn.
And what I told him, as I said, because if the numbers are good, the investors aren't going to be more excited that you're paying them their own money back in those first few years.
That's what you're
just
doing
to make it work, and that's all you're doing is raising more capital.
Exactly.
To give it back.
It's almost like an internal Ponzi scheme, and it's better to go to the lender and say, listen, we've got some remediation we've got to do here. So there's going to be a period of time we're not going to reach market rents. Can you give us interest only for the first year or two? And most lenders will go along with that as long as you got an end game. At least the interest is being paid. You're not reducing the principal portion of that, but it gives you that runway you need rather than just raising more cash. Because sure as hell the lender's not going to give it to you on that basis. So you're going to have to raise more cash, which is, I always thought of that as an eternal Ponzi scheme.
I actually shared with this guy, I used to do that when I was flipping properties, but it was the lenders giving me the extra money to make their payments. And the reason that they would do it is because that just means they made more interest. The deals were good enough, they could see the return in there. And so they would say, oh yeah, we'll give you that extra money so you could make our 12% interest payments along the way.
So that must have been private debt. Yeah, private debt.
Private debt.
The private debt guys will do that.
So that only worked against me. But when you take that same concept to an investor, then you're really just charging them more money at that point because their returns are diluted by that extra money that you're borrowing to pay back to them.
And then you take the hit when you go sell the property.
Yep.
Because you overpaid for it. Cardinal rule of real estate, you don't overpay for a property.
You make your money when you buy the deal. That is absolutely true.
All right, let me think about it. See if we can put together something like this, because I like the idea a lot. I think it would be a lot of fun. I mean, you saw how much fun I had there with the deal. It was fun to finally have something to go out and sell.
You know, when I was talking to he said, why did you wait till the very last to bring Ken in? I think if we'd given you more time, you'd have had that deal done. The 250, well, it was actually 260 or 70 accredited leads. They all responded to the ad for that property. The tool that we used, immensely valuable tool for us.
Another thing that they really enjoyed about that is they were there with other investors, and it created an awful lot of opportunity for discussion amongst themselves too that they enjoyed as well.
Yeah.
You get those like-minded people together.
Yeah.
They feel, especially in a space like investing in real estate, where oftentimes you are such a lone duck, you're trying to make decisions on your own. All of a sudden you get around, 20 other people that have the same types of goals as you and whatnot. I could see that.
I like the idea. Let's talk about it again and see what we can do.